So my profits for the week selling options with Questrade, mostly put spreads, was a net $111 US. So I'm going to go over my trades and then I'm going to look at a different scenario. What if I did 2 more contracts, or what if I let some of my trades go to expiry? All right, so first trade Monday, November 16, I sold a naked put on TWTR at a 15 strike. Stock was trading at around the same thing. Collected 55 cents. I only did 1 contract. So you can see on Monday it was trading at around 15.5 and it quickly went up and then closed the week at around $18. So the trade became profitable really fast because as long as the stock is trading above 15, then I win on this trade. So I let it expire worthless. I did 1 contract. So basically I paid nothing to buy it back. It expired worthless. So I get to keep the full profit. I only paid commission to sell. I didn't pay commission to close. So $49 US net profit. Then Tuesday, I think Peloton dropped a little bit. If we go look at the chart, actually compared to Monday, Peloton went up a little bit. Regardless, I still sold a naked put at 93 strike. So basically that means as long as Peloton stays above 93 come expiry of Friday, which is November 20th, I win on this trade. So 93 strike on Peloton naked put, I collected 75 cents. I only did 1 contract again and I let it expire worthless. So that's 75 cents that I collected. I basically paid commission to sell the trade, but I didn't have to buy it back, so I saved on commission. So that's a $69 net US profit. So combined with the first 2 trades, that's $118. I could have done more contracts, but I did 1 contract because my plan was if it got breached, I would roll the naked put. So I didn't want to roll more than 1 contract because of the buying power required. So what is the buying power required? This one required PLTR required about, I think about $300 of margin, and Peloton required, I believe, about $3,000. I think a little bit less. So this trade here, SPY, this was initially a put spread that got breached, or actually I got worried, so I decided to roll it to November 20th. It was initially, I think, a 340, 335 put spread. I ended up rolling it when I didn't have to. If I had kept it that same week when I opened it, I had opened it October 16. So if I had kept it the week of October 16, it would have been a winner. But I ended up rolling it just in case. And then when the market dropped around elections, I decided to sell a call spread at the same time. So I sold a 355, 360. And now this week, if we look at the SPY, so you could see the SPY was at 361. So it completely breached my call spread. My call spread being 355, 360. So once again, I keep losing on the call spread. This isn't the first time. So what I did is I brought the put spread higher. I brought it to the same strike as the call spread of 355, therefore turning the trade into an iron butterfly. So these are the total credits I received. So a total credit of $2.50 on this trade. So that means my max loss is $5 because it's the width of the spread minus the credit received. So my max loss is $5 minus the credits received. So $2.50 is my max loss on this trade. So you can see I collected $1.30. I collected 57 cents and 63 cents. So $1.30 was from the initial put spread and from rolling the put spread to November. The 57 cents was from selling the call spread, and the 63 cents was from bringing the put spread higher. I ended up closing the trade on Thursday for $3.60 when SPY was trading at around 357. Now the sad part with this trade, so it ended up giving me a loss of $125 net, but the sad part of this trade is that SPY on Friday ended up closing at 355.34. So what does that mean? That means if I had held it to expiry, I could have closed this. Instead of closing it for $3.60, I could have closed it for about 55 cents, and that would have given me a profit instead of $179. So you see the difference from closing it just 1 day early. If I had just held it to expiry, would have made a profit instead, and that would have given me $416 for the week instead of $111. So you could see one minor change of just holding things to expiry, obviously closing it on the day of expiry, but just holding on to it till expiry, gave me a $300 swing. Not only that, but I could have not sold the call spread, which I always keep losing on, and the put spread, my initial put spread of $1.25 or $1.30 would have been a winner. Now last Friday, November 13, I sold a put spread on Zoom at $3.70, collected $1. Now sadly, Monday Zoom fell to $3.75. I wanted to take advantage of it and sell another put spread, but I was hesitating between a put spread or a naked put because I saw that I could collect at the 300 strike. I could collect $1 if I do the naked put, but obviously the naked put scares me a little bit. With that hesitation, ZM went up, so I missed out on it. I was disappointed because it would have been an easy profit. Even at the 350 strike, which never got reached or tested, I could have collected $7, so that's $700. So if we look at Zoom here, on Monday it dropped hard, almost to 375, but then it came back up, dropped again on Wednesday, but then look at this, look at Thursday and Friday, ridiculous, closed at around 440. So that 350 put that I could have sold on Monday would have been profitable really quickly. And I think it was using about $6,000 to $7,000 of capital required to sell that naked put at the 350 strike. Regardless, my Zoom put spread that I collected $1 on, I ended up closing it, I believe, on Wednesday. Closed it for 30 cents. Now, of course, if I had held it to expiry, I would have kept that 30 cents, which is $30, and I would have saved on commission. So regardless, I got $57, but if I had let it expire worthless, it would have been $93. And let's see what the week would have looked like. It would have been 148. Now let's see if I'd waited on the SPY as well to expiry, my week would have been $453. TWLO was a put spread that I opened on Friday as well at a 260 strike. Once again, this one was definitely a winner on Friday. I think TWLO was at around 300. I closed it for 25 cents, but let's say I had closed it for 0. Let's see what the week would have been like. Would have been at 484 for the week. So it wasn't a big deal closing it for whatever I closed it for, 30 cents and 25 cents. But obviously the biggest difference here was the SPY that I ended up closing for $3.60 that I could have closed for 55 cents. Now, of course, I don't know what the SPY was going to close at on Friday. It could have closed above 360. I would have had to pay $5 to close this trade, so I would have lost more. If I closed it for $5, would have lost $265. So the week would have been a loss of $28. But the number of times where I say to myself, if I had just gone to expiry, this trade would have been a better winner. So I think I just have to condition myself to just let the trades go to expiry and see what happens. Now let's look at some other missed opportunities for the week. NEO had earnings this week. I was going to sell a naked put at 35 strike for about 75 cents, so that's $75, and I didn't. NEO ended up closing the week at 49, so it would have been an easy winner. Another one I very much regret is Nvidia. I was going to sell a put spread at 510, would have collected about $1, so that's $100 right there that I missed out on. And finally, I was going to sell a naked call on Tesla at a 600 strike, and Tesla was around 507, would have collected $1.25, so $125, but once again chickened out because it's Tesla, anything can happen. But that was on Thursday. So you could see that with just a few minor tweaks, this week could have been a completely different week. Now I was also trying to sell a put spread on Workday at around 215 put short strike. That one would have been a loser, but most likely I would have just rolled it to the next monthly expiry. Probably would have rolled it to December 18 and maybe for a small debit. So I would not have taken the loss this week, but this trade would have turned out to be a loser. So I'm glad I didn't take it. It didn't get filled. I placed the order, but it didn't get filled. But if it did get filled, I would have just rolled it for a debit and hope that by December it comes back up above 215. Now for fun, let's just see if I had done 2 contracts on everything. So 2 contracts on everything would have given me a profit for the week of $263. So on Friday, November 20th, I ended up opening 2 trades, 2 put spreads on Nvidia at 510, 505 for November 27th expiry, and Tesla 460, 455 for 95 cents, also November 27th expiry. I also have this old put spread, which was a put spread that got tested a week ago or 2 weeks ago that I ended up rolling to December 18 on Nvidia at 480, 470. So hopefully Nvidia stays above 480 come December. I've got a BABA put spread that also at the same time as Nvidia I ended up rolling to December. So at a 250 strike, so hopefully once again BABA stays above 250 come December 18. I'll try to let them expire worthless. This was an earnings trade on Chegg at a 75.70 put credit spread that I initially collected $1 on, and it got breached. So I decided to close the long put. So I collected money from the long put, about $3.15, and then I rolled the short put. So the 75 short strike, I rolled it to December. So I collected another credit. I collected a credit of $1.10. So now my total credits for this trade is $5.80. I'm going to try to let it expire worthless come Friday, December 18, as long as Chegg is trading above 75. So this is an earnings trade that went bad that I'm trying to save. And you can see here, Chegg is closed on Friday at 71. So what could have happened is, instead of rolling for $1.10, so I'll remove the $1.10 here, I could have just ended up closing the short strike for $4 and taken a 70-cent loss. So that could have been another option for me. So instead I rolled for $1.10, went from November 20th to December 18 expiry, and I'm just waiting for Chegg to trade above 75. And then finally, see, this was actually part of this week. So actually this week would have been even higher if I had kept this put spread on BABA. It was at a 250 strike. BABA dropped to 253, 252. I panicked, so I rolled it. I rolled it to January 15. I rolled it for a 5-cent credit. I initially collected 95 cents on the first put spread. So I rolled it for a 5-cent credit, but I brought it down, so that was good. I was able to bring the short strike down to 230, 225. So now I need BABA to stay above 230 come January 15. Should be fine, but I mean, I have to wait till January, or I can close it for maybe 10 cents or 20 cents as time goes by, and if BABA keeps going up. But the ridiculous thing is, if I had just held on to it this week, I think BABA closed at 270. So my initial put spread at 250 would have been a winner. So that's an extra 95 cents for this week. All right, so these were my trades for this week. If you have any questions on put spreads or selling options in general with Questrade, leave in the comments section below. And like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. Also, check out the other referral links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.